The broadcast is now starting. All attendees are in listen-only mode.
Well, good morning, everybody. Thank you so much for joining us. I've got, my name is, as you guys know, my name is Mitchell Klein. I'm one of your co-chairs for the CML class, and I've got Chuck Klein with us today. He's a managing partner at our company, Mortgage Banking Solutions, and his specialty really is mergers and acquisitions. And I really, after the secondary conference, I really thought that I was talking with Chuck, and the class kind of came up, and I thought, this might really help a lot of you guys, just to help with, just kind of generate and have a base knowledge of what goes into an M&A transaction. What does that even mean, M&A, mergers and acquisitions, and hopefully answer some questions that might be lingering for you guys. And afterwards, we'll open it up to a little bit of Q&A to hopefully help you guys with any other questions you might have. Looks like we've got 19 in the room now, so that I think that's about most people we had signed up for the class. I'll give it about 15 minutes or so, and then I'll let Chuck introduce himself, and we can take it from there. Now we're at 21, so I think that probably should have most everybody on the call now. Well, Chuck, why don't you go ahead and introduce yourself? I think everybody here pretty much knows who I am, but especially for our class here, they might not have had the Chuck Klein experience just yet.
Well, thanks so much for having me, Mitch and Lisa and all the gang at the TMBA. I'm Chuck Klein, managing partner at Mortgage Banking Solutions. And Mortgage Banking Solutions is a consulting and advisory firm, all directed at mortgage banking. Although we interface with some banks, credit unions, and other financial institutions, all of our services are directed at mortgage bankers and mortgage lenders. So we don't get outside of our sweet spot and delve into other types of things. But my primary focus is on everything related to a merger or an acquisition, and we head up due diligence. As part of our merger and acquisition area, we do company valuations. But in our due diligence team, we also work with the warehouse banks. The same people who work on merger and acquisition due diligence also work on our warehouse due diligence. And I used to compare that when we perform due diligence for a warehouse bank, it's kind of like due diligence from 10,000 feet. And when we're actually working on due diligence on an acquisition, then we really want to get inside the company and learn as much as we can about the company and focus at every single piece of the company, from point of origination through post-closing and all the other functions within that company itself. But I've been working on mergers and acquisitions since about 1992, and so don't mean to date myself, but I go back a lot further than that. I got in the mortgage business in 1973 and started out in collections. So I got a real taste for the business, going out knocking on doors trying to collect mortgage loans. So it certainly wasn't a fun job, but I learned a lot. It was a good place to start. So I worked my way up all throughout mortgage banking. I've been in every piece of mortgage banking with the exception of investor accounting and investor reporting. So every other part of the business I've been involved in. But I think that mergers and acquisitions, this isn't rocket science. We try and keep the process as simple as possible. It's really just putting two companies together, and sometimes it's a company that is not in the mortgage business trying to get in the mortgage business. Other times it's two mortgage lenders trying to get together. So that's the primary focus of our business. And Mitch wanted to focus on mergers and acquisitions, and I've been blessed by, having spoken to the TMBA many, many times on this topic, and great to visit with you. We'll keep this as basic as we can. I'm not very smart, so I'm not gonna talk over anybody's head, but it's like I said, certainly not rocket science. And we're gonna keep this real simple. And like I said, Mitch he mentioned earlier, at the end of the session, let's ask any questions, and do not hesitate to ask questions, and don't hesitate to reach out to me with any questions you may have after we're done here. So I'll make sure that you have my email address and contact info.
Well, thank you for that. And why don't we go ahead and get into it? First question I have, can you walk me through the difference, in an asset sale versus a stock sale?
Sure. In a stock sale, what we're doing is we're selling some or all of the stock of the mortgage company itself. And it may not be stock, it could be a partnership, but we're selling all the ownership of that. When we do that, when you sell the stock, then you're selling, every piece of the company. And with that comes liabilities that could be known or unknown. And Mitch, today, that's primary detriment in doing any type of a stock sale. And we're actually working on quite a few of those right now. But over the last probably 5 years, I think with the exception of this year, every sale we've done over the last 5 years has been an asset sale. So anyway, when we're selling the stock, one entity is going to sell a substantial amount of stock. It could be a minority interest, it could be majority interest, or 100% interest in the stock of the company. So they're taking over all the assets and liabilities, but they're also taking on, as I said, those unknown liabilities. And where the real catch here is that it could be litigation can come up after the fact. And let's say there's an ex-employee who has something that wasn't treated fairly, and he thinks there's something was done incorrectly during his employment. He can come back after the fact and sue the company after the acquisition. And a lot of times it may be for selling to a bigger bank that he sees a bigger balance sheet. So instead of suing for any type of sexual harassment or any other thing like that, then they can come back and say, hey, we've got a much bigger owner now that has a much deeper pocket. Let's come back and sue them. Now, those things are all very unlikely, but more likely to happen are such things as repurchase demands, that something happened in a previous sale, that there was something wrong with the loan, might not even be anything wrong with the loan, it could have gone into default, and it could be subject to repurchase demand if it happened. And they come back, investors can come back later, such as Fannie or Freddie, or even your private investors come back and say, we purchased a loan, and whoever bought the stock of that company would then be liable to repurchase a loan. So that's the primary difference. When we sell the assets, all we're doing is selling the assets of the company, certain assets and certain liabilities. What we're trying to do in most sales, they're trying to accomplish is to buy all the people, and primarily the loan producers. But they want, today they want more and more producers, more loan officers, more originators, more branches to go out and generate loans. Now, they're also going to pick up the support staff, processors, closers, funders, underwriters, all those other facilities. Could be servicing operation as well. Those people are coming over. So although that's not an asset, that's part of the company that's going to come over, and you acquire the assets and the liabilities. Now, what happens if a mortgage company, the reason asset sales are particularly popular is if you look at the balance sheet of a mortgage company, they all pretty much look the same. It doesn't matter how big they are, the numbers are just bigger, but there's not a whole lot of noise in that balance sheet. There's not a whole lot of categories. Primarily what you have is you've got stock, you've got some loans for sale, you've got some payables and receivables that are, sitting in the asset category. You got MSR assets is another big piece of it. And then you got your warehouse line. On the liability side, then you might have, some loans to run operating capital, operating loans such as that. you have the offsetting debt at the warehouse bank for the loans that are in the warehouse. And that's pretty much it. So if the owner of the company says, okay, well, I'm just going to sell you my assets and sell you my people, well, it makes the acquisition for the acquirer, the buyer of the company, pretty easy, because what he's going to do is tell the owner of the mortgage company that's selling, you go ahead and keep your cash. I don't need your cash. So take your cash out of the company. You're going to go ahead and close out your warehouse lines. So we'll bring your warehouse balance down to zero after closing. Close all the loans out in the warehouse, get them delivered, and all the loans in the warehouse, that you have debt against, they're going to all pay off. So really what's left, if you clear out those, and then MSRs, we'll either buy the MSRs, your mortgage servicing rights, or you can sell them and keep the capital for those. So if you take all that away, the only thing's left is really the furniture, fixtures, and equipment, which is a pretty minor asset on the balance sheet. So the acquisition price can be very reasonable. That if you're paying as far as the balance sheet goes, but really the only thing you're doing is paying for the furniture, computers, things like that, and it's a depreciated value. So once again, when you look at the balance sheet of a mid-sized mortgage company, it might be $1 million, might be $500,000 in FF&E. So that's the primary difference, Mitch. It's the ease, and most deals today are still being done as asset sales. Now, because of the difficult times in the mortgage business, we're seeing a few sales where companies of equal size are actually merging their two companies together. So a little bit different market today.
Well, I'm glad you brought those last 2 points, because that kind of leads me to my next question. And what would you say is your standard valuation formula for a company, and how does this vary in an asset sale versus a stock sale?
Sure. Our formula for value has been the same really over the last, probably 20 years. The formula hadn't changed. The numbers changed a lot. The formula doesn't change. But we believe, based on historical sales, that a mortgage company is worth its book value. And everybody understands book value. We just got, once again, we go back to the assets and liabilities. Assets minus liabilities equal equity, and that's the book value. So it's the book value of the company plus 2 times earnings. Now, this is where it gets dicey. Is okay, earnings. Well, in a normal market, and those of you who may not have been in the business very long, well, what is a normal market? Well, I can tell you, I'm not sure I can tell you what a normal market is. I promise I know what a normal market is not. A normal market is not 2020 or 2021, because there was so much business. Historical profits were made in 20 and 21. Companies who'd been in business for 20, 30 years had never made as much money as they did in those years. Everything fell in place properly. Low interest rate environment, lots of demand for housing. A normal market is also not 22 and 23. Because just as what comes up must come down, the top just dropped off the mortgage business. Interest rates rose, demand for housing went down, and as we've seen today, most mortgage companies are not doing very well and haven't done well since 2021. So those 4 years make it very difficult, for earnings. But in a normal market, and I call it a normal market, 2019, 2017, 2016, that those are typical years where, their mortgage companies are continuing to produce loans. Refinances are not the primary driver in those markets. It's a mixture of some refinances along with new loan sales on new homes and existing homes. It's being made up of. So if we try and normalize that, and when we go to your earnings, and that's where the really catchy part comes right now, is we have to understand what your earnings are, not only today, but what they're going to be. So it's a long way, I'm going around to get to the answer of how do you project earnings. But if we're going to pay you the book value plus 2 times earnings, then we're going to say, okay, at your current track today, if you're making money, what do you expect to make in the next 12 months? and we're going to help you budget to create, and most mortgage companies will create a budget over the next 12 months. We want to see what your budget numbers are and how you arrive at those budget numbers, okay? So let's say that your budget is accurate, then your earnings, could be $1 million. So let's just use $1 million for a number here. And your normal earnings are $1 million a year. So if it'd be your book value plus $1 million in year one and $1 million in year two. So once again, if your mortgage company has a book value of $1 million, your earnings are $1 million for year one, year two, then the mortgage company, in our opinion, has a market value of $3 million. Okay, makes sense? Well, the challenging part, as I said, becomes, well, how do we get to these earnings? And what I'm earning today, what I'll be earning next year? So the next 12 months are a lot easier to forecast than the months after that. But we'll talk about our valuation for them in a minute. But back on to Mitch's question about earnings. So how would we pay for this mortgage company? And I can tell you historically that there's been times when we've been able to get all that of the entire purchase price paid at closing. So if this was a normal market, then I'd say, hey, the likelihood of getting you 3 times earnings, we get that all for you at closing. So if we close next month, you should be, your value should be about $3 million. Now that we haven't seen that market in a while, so most companies today are not willing to pay this 2 times earnings we're talking about. That's what we call the premium. That's the premium over book that mortgage companies are selling for. So the premium paid at closing today is negligible. Very little premium is getting paid. Why is that? Because nobody's making any money. And in 20 and 21, the irony was nobody believed you could sustain that type of profitability over long term. So they pay you some premium, some portion of what those earnings look like, and the rest would be paid in the form of an earnout. Then we get to 22 and 23 when we have these terrible years where nobody's making any money, nobody wants to sell their companies. So we go from a premium at closing to the premium being paid over an earnout period. And what that means is that we'll pay you a premium, but we're only going to pay you as you earn it. So one formula would be, okay, well, we'll pay you 100% at the closing table. We'll pay you 50% at the end of year 2 and 50% at the end of year 3. All right, that's your 2 times earnings. That's one formula. Well, that formula changed in 2020, but we weren't seeing 100% being paid at the closing table. So it would be maybe a fraction of that be paid at closing. And at the end of the first year, we pay you up to 100% what you actually earn. That could be higher than what we projected initially. And that's part of the criteria in our negotiation process. The 50% earnings in year 2 and year 3, once again, will be paid at the end of those 2 years. So we try to get back to that 2 times earnings number, Mitch.
Sure, that makes sense. And thank you for kind of explaining the nuance of how that kind of has changed in the last several years. And again, Class, I feel didn't really gather that. He's basically saying, you're paying book value at closing, and then earn out earn out 100% at the end of year 1, 50% at the end of year 2, and 50% at the end of year 3.
Right.
That's 50% of that current year's actual production.
Those numbers change a little bit. I don't ever remember doing a deal that we weren't able to get that, at least that formula paid. But Mitch, we had banner years where we got 3 times earnings paid at the closing table. Now that was, crazy times. And somebody really wanted to buy that mortgage company. They were a hot ticket. Somebody wanted to be in that particular market. That's not a normal sale any more than somebody said, well, I'm not going to pay you earnout. I'm just paying your book value. Well, those sales get done. I don't think we've been involved in anything like that, but they do get done. So.
Okay, and then okay. Can you explain to me the importance of having a cohesive culture in a merger or acquisition?
Absolutely. I can tell you that culture is probably the most important ingredient in sale. And, culture isn't just two companies that both do retail originations, two companies that are both located in Texas. That's not culture. It's a lot more than that. It's, maybe it's retail originations. We want to challenge those, but really it goes beyond that, that the culture of the two companies has to line up, how they go about doing their business, how they treat their people, the benefit packages, things like that. And different management styles, dictate different culture. And, we see so many different ones. I think Mitch has told you guys that we look at, mortgage companies all over the country for our warehouse lenders, and all these different cultures, everybody's got a different way to, to create this perfect mousetrap, and they all do it their own way. And they all have a pretty good way to do it. But, that comprises culture, how they go about doing it. And it's personalities, it's like you get two people talking to each other, and they have to work together. That's critical. They have to be able to not just the two owners or presidents of the mortgage companies have to work together. It's got to be the staffs have to be able to work together. So, we try and spend as much time as possible prior to any type of negotiation, getting to know the culture of each company and understanding. Now we're very lucky that we see so many different mortgage companies. We have a good idea of companies out there and what their cultures look like before we ever start introducing people to each other. So we have a lot of support, and our people are very good at relationships dealing with the mortgage companies that we review. So that helps us a lot when we make those introductions. A lot of times companies we don't know, but I always stress that part of the due diligence process, not only is it, we'll talk about due diligence in a second, but not only is due diligence verifying data, due diligence is get to knowing each other. It's almost like a dating period where you get to know the other person, get to know what they like, what they don't like, how they go about doing their business. And it's because really, when you do a merger and acquisition, it's like a marriage. And I always tell people, you better get to know each other before you start walking down that aisle. Because if you got any questions walking down that aisle, do not do it, because it's not going to get any better after closing. So you really want to get to know each other and like the people you're working with, and believe that you can work with them and work together and create a better company together. And that's the goal of the whole thing.
Wonderful. Tell me, what kind of incentives are reasonable to give to production staff and to keep them on board? And then, what kind of incentives are reasonable to retain, that quote unquote key individual who kind of keeps that group together? And also, I thought you were going to kind of hit on that key individual and the culture piece, but kind of also elaborate on.
Sure. Well, I think every company's different. And it could be the president of the company, it could be the head of production, it could be maybe just be a smaller company. There's just one dynamic branch that needs to come over. But all the majority of the producers, there has to be one key individual that they report to, that they identify with, and that they can buy in. If that key individual says, "Hey, I'm buying this deal, I'm going," then that's the guy you want to have come over. It's usually either the president of the company or it's a production manager. And we're talking about, Mitch, I'm talking about your originators. We're not going to talk about the staff right now. We can talk about incentives. But I think that, what we've learned, through history, that you see these gigantic bonuses paid out to originators and managers when they're being recruited by the company. And what mortgage companies should have learned, this isn't a new concept, been going on for as long as I've been in the business, people being paid bonuses to come to work. What they should learn is you don't pay it all up front, because, there's just, I would say the failure rate on that is probably 90%, that people move around, and they may, as I said, they may think it's a great idea but if they're coming only for the money, that's not the right reason to come. They have to be able to operate that structure. So anyway, back onto the psychology of it is that you don't pay it all up front. And it's a matter, it has, a direct relation to how much money this guy makes. And once again, we're in a terrible market right now. So, you could have your top producer in the company not making a lot of money right now relative to what they made in 20 and 21, which was the best of the best, relative to what they made maybe in 2018, 2019. And those are the things that we have to look at. But whatever that number, that buzz point is, I remember many, many years ago when we worked for a mortgage company. They acquired a company in Virginia, and this manager walks in. He said he wanted a $1 million signing bonus. This is like in the back in the early 1990s. And the comment by the president of the bank was, who does this guy think he is? Michael Jackson? We're not paying him that kind of money. I mean, it was like movie star type and rock star type incentives. Well, that's all changed today, and we know that. But I think it needs to be relative to what the guy's earning, and if the number has to be significant to him. But you got to make him stay. And the key to paying his bonus is not just a one-time happiness. You want him to stay for a couple of years until you get this company the two companies put together, get it on the road, get the companies functioning together, so he stays with you through the transition period, and you're not just paying money out the door for him to come over and leave you in 30 days. So many incentives are set up, to get a base bonus. When we close, we're going to pay you X amount of dollars. We're going to pay you more at the end of 6 months. We'll pay you another bonus in 12 months, another 18 months, and another 24 months. So you may have your bonus fund set aside.
Kind of a tiered incentive bonus, you're saying, probably makes a little more sense.
Say it again, Mitch.
Kind of like a tiered bonus, incentive where paid out over time, not.
Well, it's just it all come up front, and that doesn't count any type of additional incentives you might want to get him. That if he produces beyond what he normally would produce, let's say he comes in, does a great job, he's bringing a lot more loans than he had historically, then that can go up. But once again, you don't pay it all out on day one. You want him to stick around for 2 years to get through it. And if he leaves, well, he doesn't take any of the future bonus with him. So those are the types of bonuses that, and we've seen some really key loan officers participate in that as well. A lot of times where that's structured in the purchase price is it could be structured in proceeds the seller would receive. And the buyer goes to the seller and says, we think it's critical that you maintain these. And we're going to pay you these incentives, but guess what? If your people leave, you're not going to get those incentives because this is an earnout. So why don't you distribute some of those dollars back to your personnel and back to your key producers, and you be responsible for that. You keep them in the fold, and they'll participate with you. You stay, and they stay, the whole thing. And there's a lot of help you get from the attorneys in structuring those incentives to keep your staff on. And you can pay incentive staff as well. If you've got a really good operations manager, some underwriters, things like that, there can be some additional incentives too. But once again, you're eating into the purchase price when you start doing those things. You have to be careful as you're budgeting, that you do have the funds down there to pay these guys at the end of those periods. But again, it shouldn't be anything that's, detrimental to the operation of the company in the future.
Okay. Well, that makes a lot of sense. Thank you for expanding on that.
Well, one thing I was going to add, Mitch, back onto earnings. What I didn't mention is when we say, okay, we're going to figure future earnings in this multiple. Well, once again, in a normalized market, when you say, okay, it's book plus 2 times earnings, what earnings do you use? You got three earnings that you can use. You can use trailing earnings, which was last year's earnings. You can use current earnings, which they are right now, or you can use projected earnings. And Mitch, we've done deals under every single one of those and a mixture of all those things in paying those earnings out. It could be, we're going to pay you at closing last year what you did, we're going to pay you next year what you actually earn or projected on. And it depends on what track the company's on. Let's say that this company had just acquired a large company on their own, another large company, and they brought in some very significant branches you could stay on too. then those would be reasons to use projected earnings versus trailing earnings, providing they can keep those people.
Sure. Okay. No, yeah, thank you for expanding on that. Yeah, that makes sense. Oh, sorry, I skipped ahead here. Well, actually, let me ask you this. Oops. Oh, I'm sorry, guys. Hold on. Just kicked out of the presentation. Well, can you walk me through the due diligence process in its importance?
Yeah, absolutely. Really, due diligence is validating what the seller or the buyer has told you. If you're doing a true merger where, let's say it's a 50-50 merger, you're putting two companies together, and they're trading shares of stock of each other. So in that case, you're going to want to do due diligence on both buyer and seller. Each side does their own particular due diligence. In every case, you should perform some due diligence on the buyer and seller, depending on where you're sitting. But really, it's proving up what the other side has told you they're doing. So, we're going to ask what you want to do is, most importantly, is to see how the company operates. We want to make sure you're operating efficiently and you're operating within the guidelines of investors, and you're operating prudently as well, that you have a good management team, because you're telling us you have all those things. So let's spend our time on operations. So what we're going to review is we're going to look at the company and all the systems, all the people, all the departments from point of origination all the way through post-closing. Okay, so we're going to look at processing, closing, underwriting, shipping, funding, all those pieces. We're going to look at secondary marketing. We're going to see how they go about selling loans. Who are the selling loans? So they do mandatory, they do best efforts. What is we look at, what they're, how they're recording their sales. We want to see, what their, position reports are. We want to see every piece of operation. Are they using a hedge advisor, on and on and on. We want to spend a little time in HR. Are you managing HR properly? Especially because pay attention to compliance and QC. What is the quality of the loans? We want to look at investor reporting, investor accounting. We want to see investor report cards. We want to see what kind of job you're doing delivering to your investors. Your investors happy with those. We want to see any repurchases you've done historically, because history can tell us what's going to happen in the future. What's the quality of your loans? Are your loans performing properly? So, we want to look at the company, as I said, every single asset and phase of the company, but we're really going to look at the management team. So in our due diligence process, we spend a lot of time on interviews with the department heads, see the capability of all those guys, how they're running the departments, the quality, what their background is, how much experience do they have, how they go about it. Like I said, we've got a pretty good staff who sat in all those positions as well, so we're able to assess the ability of those people. But we want to again check it. But really, one of the most important factors, we want to see the president of the company, what he's all about. Is he sticking around for long term? Is he here for a short term? Is he trying to get his money and run? What's going on here? And what's the opportunity for him to continue on to be part of our company? And how's he going to run his company? And really, the bottom line is he can be able to work with us and for us, and can we all work together in this project going forward? Because once again, we're not doing this to give the guy a break and give him 30, 60 days and get his money and get out of here. That we want to have him to stay. In most cases, the owner is a guiding force of the company. We want him to stay on. We'll be part of the go forward company, the new company, and we'll find a role. We may have another president of the company. Maybe he could be CEO, but he could be head of a region. It just depends on how it's structured.
Yeah.
We look at the financial side as well. The due diligence really, we recommend that you bring in accountants to do the financial side. There's an audit team, could be one of the major accounting firms out there, but, to go to their auditors, see how they're doing, spend some time. If you don't have the accounting staff to do it, you need to hire accountants. And we've got the people, we can help you on that side too with the accounting piece. Our normal due diligence staff does not, do accounting due diligence. We'll bring our accounting people to do that as well, especially if there's any question marks about how they're accounting for their loans, anything funny on the balance sheet or the income statement we're not sure about. We'll have our accounting people look at, or we recommend they have their, accountants take a look at, much closer look at it to make sure they're accounting for all the loans properly.
Okay. Well, I think for our last piece here, can you explain some of the difficulties that are associated in acquiring a new company?
Yeah, this is just a real tough market because what we, in an acquisition today, what you don't want to do is put the companies together and you start losing money on day one. Now, the reality is most mortgage companies are losing money and have been losing money for the last several years. But how close are you to break even? How quickly can both sides get to break even? How can the merged companies get to break even? And everybody, has the impression that, well, if we put the two companies together, we're going to achieve some efficiencies. And I don't disagree with that. The problem is it doesn't happen on day one. It could take months to achieve the efficiencies. You got to figure out, when you put the two companies together, you've got two accounting departments, you got two secondary marketing departments, two HR departments, all these processes and closures. And although you can utilize most of the staff, the production staff, process closures, underwriters, that they can normally find roles for everybody, do you need two accounting staffs? Not to say anybody needs to get, let go, but maybe they can become part of another accounting staff. You put the two together and you should be able to achieve great efficiencies. You only need one secondary marketing department, one accounting department, one HR department, one compliance department. All those things can be merged together and you should be able to save some in people who leave or people who, you just may have to lay some people off who don't quite make the cut. But, those are hurdles you got to see in the vision in due diligence. Where can we achieve these efficiencies? And once we achieve them, what does the company look like on a go-forward basis when we put the two together? What does the P&L statement, the income statement look like? What are your profits going to be? What are your losses going to be? Based on a given, level of production. And we try and project growth. In the old days, I say old days, prior to 2020, we'd say, mortgage companies should be expected to grow 5 to 10% a year in production. And most companies will budget that we're going to grow our production. If we don't even hire any new branches, you never budget your company to do worse. You're always going to budget your company to be more efficient, to do better, to produce more loans. So we'll normally budget about a 5 to 10% increase. Now, if you add more branches, if you have branches in the queue that may be coming on in the next 30 to 60 days, and those type of things, branch managers, more originators, those type of things, those can all be taken into consideration. But, we want to project the growth in production. We're going to look back historically to try and determine what the heck you did as far as income and expenses. Now, Mitch, as I've said to a lot of our clients, I don't really pay attention to dollars. What I'm looking for is the profit margins in each of those categories. So, like as for instance, gain on sale on the income statement. Okay, well, what percentage of your production is gain on sale? What basis point percentage is it? If we look at historical trend, if we go back 5 years, look what you've made over the last 5 years, can we see some sort of a trend and what you're producing today? Service fee income, once again, we looked at what your service fees were based on your MSRs. What should that be? Expenses, there's much more, a lot more items on your expense side of the equation. You've got your personnel expense. Salaries are pretty easy, unless you're going to have some layoffs. When your salary is consistent, you're going to have some type of growth factors. People want to raise, they want inflation factors, some sort in there. But most people want to raise every year, so we increase salaries by 5%, something like that. Just an arbitrary number. Commissions should be directly relative. So once again, if we look at what your commissions are, and here's due diligence comes out, Then the guy tells us, well, our commission, we pay all our commission, our loan officers 1%. That's what they make. We go back and look at the commission structure based on what they've done the last 5 or 6 years. And hey, man, it's like 1.6, 1.7, 1.3. That's not what your commission structure is. So we validate some of those things to due diligence, but also it sets a trend on what's going to go forward. So once again, we're trying to normalize expense and income. If you give us a certain criteria for production, well, then we can fill in what the income expense will be based on what the basis point percentage of that volume is. So a good example, like I said, we normally project about a 5 to 10% increase in production. Well, right now with the markets, 2020 and 21 were the same. In production going up like crazy. 2022 and 23 were terrible. We thought 23 would be a much better year. Certainly wasn't. Probably a worse year than 22 was. The base guide we're using now, other than just to have something we can kind of hang our hat on, although it's not accurate, is the MBA projection. So we're kind of following our valuation, what the MBA is projecting. And that number changes every single month based on what's happening in the economy with interest rates and with production. So, but we're using that as our base guideline. If the MBA projects, 12, 24, 36 months, what those percentages growth will be for most mortgage companies. And that's about as close as we can get to reality today, unless the company's doing with it, like I say. But they have a real solid formula how they're going to increase that production based on things in place, such as new branches. They just opened a new region, those types of things.
Sure. Well, thank you for answering my questions. Now, I see that we actually have a few questions from the attendees. First one is for 2 times earnings. Does that mean 2 times annual revenue? I'll let you elaborate, but that has to do with your actual net profits, net income. So after all your expenses.
Yes. Yeah, we're looking at net pre-tax. It's double net. It's pre-tax net income. Now we go back to that question I threw out a minute ago. What earnings we base it on? Is it going to be? Is it projected? Is it current earnings, or is it trailing earnings? And depending on what the market is, the current market is probably what we're going to hang our hat. Is what those earnings will be. But yes, you're correct in your question. It is net revenues.
So in the current market, would you say that trailing earnings is kind of the standard right now, or projected earnings?
What I'd recommend, Mitch, is look at your current earnings. Again, where I'm going, not the dollar amount. Let's forget dollars. Let's look at what the basis point percentage has been. Let's go back 5 years and try and get some consistency with those margins are in each income and expense category, and use that in our go-forward model. Okay. Then we'll use an arbitrary production number to say, okay, this is what we believe production is going to be. Now, let's say if we just, once again, for an acquisition valuation, I want both sides of the table to sit down and agree. Okay, this is what we think we can do. Everybody says, okay. And one side may say, hey, well, I think we're going to do $1 billion. The other side's $1.2 billion. Okay, let's split the half. Split the middle, make it $1.1 billion. Let's project that's what it is, and let's base it on that. Okay, but my thought is it's going to be projected earnings, but it's based on what historical has been, primarily what you're currently doing.
Okay. Well, I've got another question here. Now you don't have to get into your exact dollar amounts, but the question is: it is evident that the enlistment of a consulting firm is necessary during M&A. Can you give just a general ballpark of the expense related to consulting services during the M&A? Maybe it's a percentage of the purchase price.
Well, I can tell you how we operate, and the answer is it depends on when you bring us in. If you contact me today and say, hey Chuck, I want you to sell my company, well, it's going to be a different formula for compensation, because we're actually going to include what we call a success bonus. That because we went out and found you a buyer, and we don't go out and find one buyer, we go out and find you several buyers to talk to. then we're paid a bonus on producing that buyer for you. But in pure consulting work, then it's going to be based off, the hourly fee. We charge by the hour. Now there's two pieces, and what I want to help you with is I want you to gauge me before you get into, and I'm assuming that if it's, once again, if all I'm doing is advisory and consulting work, you've already found your partner, and all you want me to do is come help you to make sure you're doing something that, number one, is prudent, and number two, will keep you guys in doing business the proper way, and you strike a deal that's you're not being taken advantage of. So I want to help you negotiate your letter of intent, and I want to help you negotiate the definitive agreement. And then if you need help with due diligence, and some people think it's a conflict for us to represent you as your advisor and as your due diligence firm. I don't feel that way at all, but we can do it either way, and we can recommend others. But I highly recommend, if you're going to perform, if all you're doing is selling your company and you're bringing in, selling to another company, you may decide you don't need to do due diligence on them. You may be selling to a bank. You don't need to do due diligence on them. You're selling to an individual, and you don't have any due diligence to do. That's different. But if you're buying a company, then I highly recommend you have somebody like us perform the due diligence. You better know what you're buying. Have a really good idea that you're able to prove up everything the guy is telling you. So back on the dollar amount, I charge an hourly consulting fee for my time. And what I'm going to help you with, once again, is negotiations. That we're going to help you. I'm going to handle all the conversations between the buyer and the sellers. I'll act as your go-between at all times. I'm going to have a conversation with each side, excuse me, individually and jointly. So we're involved in all those conversations. Excuse me. It's rough depending on, when we're brought to the equation, but, to have us perform purely advisory services, I'd say probably somewhere $15,000 to $20,000 from start to finish. If we're involved in finding you the partner, if you want to hire us to go out and find you a mortgage company to buy you, then we're going to charge success bonus, and that will be a percentage of the proceeds that you're actually earning when you walk away. And it could be what you paid at closing plus some percent of what you'd be paid over a period of time as you receive the benefits that we would receive initial compensation, some percentage of that, a basis point percentage. If you want help in due diligence, it just depends. It could be as low as $15,000, might be as high as $35,000. If you want full accounting support, it's probably going to be on the higher end. We've had due diligence projects go over that amount, but I'd say somewhere between 15 and 25,000 is pretty typical for due diligence services.
Sure. Okay. Well, I think that certainly makes sense, and I think for most of the teams, I have to imagine they're probably going to be in that first camp. We've already got the company we're looking at. We just need help with the due diligence and evaluation.
Well, it starts out that way a lot of times, Mitch. I'll take a look at the deal, and I'll say, I think this is okay, but I don't think it's the right partner for you. I don't think your cultures are lined up. And it doesn't happen all the time, but it does happen sometimes that I want to make sure it's a fair deal, and I'm trying to help my client to get the most successful execution and a home for himself and his team as he can have. And if I think there's a problem, I'm going to tell him, I think we might be able to help you. I'm not looking for more work, although I love to have more work, but I'm not going to recommend you get into something I don't agree with. Now, if you want to do it, if you made up your mind that you're going to get this deal done, hey, let's get it done. I'm behind you. But, there comes times, a lot of times I'll step in and say, you might want to talk to a couple of the people. I think there's some opportunities out there. And there's a lot of buyers. There's a lot of strategic buyers. Other mortgage companies want to buy mortgage companies. So they're lined about the door. More difficult is merger partners and partners who want to buy minority interests. Those types of things are more difficult to find.
Sure. Okay. Well, Harold, you might be able to tell me if I'm wrong, but I think that's all the questions we had, or all the Q&A questions we have. I can give another minute to see if anybody else has any more for us.
That's all we have currently.
Oh, that completes questions. Well, Chuck, thank you so much for your time and walking through us and helping me out with this. I hope it was a benefit to the attendees. And, you know, you and I can talk about this often, but, you know, I think for a lot of people, it might be a little bit like drinking water from a fire hose. So I hope we did the best we could to kind of give you guys a soft one-on-one course for this. And you guys have any questions, you guys have both our information. We'd be happy to help you.
Yeah, absolutely. You know, don't be afraid to reach out. You know, there's no such thing as a dumb question. You know, we've answered questions at all different levels, and glad to help any way I can. I mean, we want you to be successful at every level. And most importantly, in this class, be successful learning. You know, if we can help you at all, get a little further down the road, understand the process. Well, I'm always glad to help you.
All right. Well, thank you so much, Chuck. And thank you, Carrie and Carol for getting the class coordinated. And we wish everyone the best. Hope you have a great evening.
Great. Thanks so much, Mitch.
Thank you. Bye.